Welcome back. In fact, the last panel, I think, chaired by Ashley, mainly focused on mainland China and a little bit about Hong Kong's role in growing and opening up China. The focus of this second panel is more about Hong Kong, about capital markets. That's why the title of this panel, as Sarah mentioned, is Spotlight on Corporate Behaviour, which probably is quite a hot topic these days with some of the crazy share price movements, especially for some companies listed on the GEM market. In fact, it begs the question as to whether our listing rules may be too lenient. I think all of you will agree with me that 2015 was an extraordinary year for the Hong Kong market. As I mentioned in opening speech, Hong Kong ranked number 1 in the fundraising by IPO. It's also a year marked by violent swings. Market turnover rose to a high of 292 billion on 9th of April, only averaged out to about 106 billion for the whole year. The average turnover for the last quarter of 2015 was only 68 billion. And then it got back up a bit for January, which averaged out to be 82 billion. Now, the benchmark Hang Seng Index reached a dizzying height of 28,589 points on the 27th of April, and then retreat back by almost 28% over the next 5 months and dropped below 19,000 in January 2016. Now, the question that we would like to ask is to what extent were the violent movements of our market and of certain shares over the last few months caused by what happened in the mainland China and the rest of the world, or were they due in some part to the behavior of some company listed on our market? Some people say that this volatility is a new norm that comes with the territory of embracing the mainland opportunities. Opportunities of such potential that makes markets from London, Singapore, would be quick to snatch the Hong Kong slackened race. But will our listing rules stand up to this new norm? Should we be concerned about certain controversial corporate behavior, such as backdoor listings, reverse takeover, shell companies, etc., etc.? And if so, what can be done? What should be done? I'll be putting some of these questions to our distinguished panel. Let me introduce on the far right, Brian Ho. Brian is our Executive Director of Corporate Finance of SFC. And then on my immediate right is Tony Tsoi. He has previously served on the committee of the SFC and Hong Kong Exchange in various capacities and is a prolific writer on a wide array of interesting topics. Next to Tony is Mr. Stephen Taylor. Stephen is a senior partner at Deloitte China, and he's the current serving chairman of the Stock Exchange Hong Kong Listing Committee, and is also a member of the Financial Reporting Council Operations Oversight Committee. Pru Bennett is head of BlackRock's corporate governance and responsible investment team for the Asia-Pacific region. And last but not least, Dr. K.S. Lo. K.S. is the chairman and CEO of Great Eagle Holdings Limited, and he is the founding chairman of the GEM market. I hope my questions will generate some interesting and lively debate. At the end of the questions, I will put 3 polling questions to the audience before I invite the audience to raise any questions they may have and then wrap up. So first of all, let me pass over to Brian, because Brian is going to set the background scene of the market and highlight some of the issues I mentioned earlier. Brian.
Thank you, Carlson. Firstly, I've got a couple of slides, so can we now have the PowerPoints? Yes, since the establishment of our corporate regulation team, we have been focusing and have been following themes of corporate behavior. And these couple of slides, we basically prepared them a couple of months ago, and for the purpose of today, we updated them. Now, the first slide, we try to look at a market snapshot between 3 years, 2013 to the end of 2015. And we pick, firstly, any 6 months during this period, if the price of any stock doubled, then that falls into the category. Interestingly, there are 860 companies where the market cap or the price at least double. Remember, these are companies, not incidents, not times. And of which 139 companies actually surge the price by 5 times, 56, 10 times. Now, more interestingly, of the 56 companies, actually, 39 were loss-making. And 10 of them, the other 10, were having a PE of over 50 times. And obviously, during the period, Hang Seng Index lowers its 1946 and highest is 28,589. And of the 56 companies, 31 changed their company names and directors. And 37 of the 56 companies actually are big ones. They have market cap over 1 billion Hong Kong dollars. And of the 860 companies, 469 actually are having market cap of over 1 billion. Now let's use another angle, second slide, please. Now let's focus on 1 billion plus market cap companies and take the period, say, ending July till 15. We now have 227 companies where market cap over 1 billion, actually the market cap double. Of the 227 companies, 154 of which actually are either loss-making or have very thin profit and defined to mean PE over 50 times, of which 110 companies loss-making. These companies, 110, represent quite a substantial portion of the Hong Kong market. And we are actually working with the stock exchange to look deeper into, see if there is any correlation between these companies and things and themes such as public float pattern, any use of general mandate frequently, convertibles, and backdoor listing. And more importantly, any issue about intermediaries' behavior. So next slide, please. In panel 1, I think I heard that our current market PE is 6 times. Interestingly, if we look at this chart, 28% in terms of number of Hong Kong listed companies, main board, actually are loss-making. 3% over 100 times PE, 3% between 50 to 100 times, and probably 66% below 50 times PE. These figures are as at end of January this year. GEM doesn't look, you can say, even worse. And basically, it's 55% loss-making, 3% 100 times PE, 6% 50 to 100 times. Next slide, please. We have some case studies and no-name basis. We discovered that there are many companies having this sort of pattern where the company was included in an index such as FTSE in this case. Within 1 month, the price doubled and keep surging up until MSCI also announced the inclusion another 30%. And one day, SFC announced concentration of shareholding warning, the price free fell. Another case study. Similarly, you can see also things, there is backdoor listing of assets, change company name, and then announce of inclusion of index, price went up, and our announcement of concentration. Next slide, please. These companies with soaring market cap getting into the indices. The size of them actually are very big, ranging from 50 billion to 300 billion. And the impact of this, index tracker funds, ETFs, have to buy them. And recently, I'm sure most of you are aware of the fact that MSCI was consulting on the new policy after FTSE already took the decision of SFC's warning into consideration, and accordingly, 70 stocks of FTSE and 18 of MSCI were excluded from the indices. Next slide, please. And then the last two slides relate to JAM. And I think suffice to look at just the two columns in red. Very quickly, after IPO, the price jumped to like 21, 17, 70 times. And after a while, 3, 4, all over 90%. Last slide, please. So people actually say, oh, JAM is more for high growth company, high tech companies. But actually, closer look, it is not the case. We discover actually many of them actually are traditional mature industries, such as consumer goods, construction, and only 80% IT companies. These are facts we picked up. I leave it for other panel members to comment. I'll stop here.
Okay, thank you, Brian. I think this overview goes to indicate some of the issues I raised in my opening remarks. And they're clearly worrying signs, no matter how you look at it, of extreme share price volatility and market variation. Now, I would like to put my question to Tony, who is a market commentator, I think an analyst. What do you think the key reason for this extreme price volatility? Is it just because of the global financial crisis?
Well, two reasons jump out at me. One, it's backdoor listings. Stephen will talk about it, so I would just make a brief comment. Backdoor listings have been around for a long, long time. It's nothing new. But what is new in the last couple of years, I have observed, it's in the old days, people talk about backdoor listing, they whisper. Now they talk in public in very loud voice. They actually, the media talk about it. There's actually a step-by-step guide as to how to manufacture a shell and how do you exit. And so it's troubling. I think but I will leave that to Stephen to talk about the recent phenomena of backdoor listings. The second reason it's China. There is a macro phenomenon. It's the buy China story has become a sell China story. So whether China is in transition or it's being rebalanced or it's actually in collapse, depending on who you talk to, that has an effect, of course, on volatility. And but there's also a question about corporate governance. And now in the last 20 to 25 years, the best thing ever happened to the Hong Kong market. It's the integration between the Hong Kong and China stock markets. And nowadays we cannot imagine the Hong Kong market without Chinese companies. But this integration has not been easy, has not been without problems. There's no doubt, and undoubtedly, the standards of corporate governance in Hong Kong, in China, have improved. But it's from a low base, and the growth path, has been uneven. If you just look at the past year, if you look at the China market, as a lot of Western investors, have learned, we learn new vocabulary. When we met you, if you refer to national teams, it's not just in sports. I mean, in equity markets, we have national teams. And malicious short selling. Well, we understand legal or illegal, but malicious. And what is malicious? Anyway, so corporate governance with Chinese characteristics are an acquired taste, but some international investors, choose not to acquire this taste, or they don't They don't know how to play this game, and they choose to play China through Hong Kong. That has been a major role for Hong Kong in the last 25 years. We have benefited tremendously from this role. Now, how do you effect this integration, with different standards of corporate governance? Hong Kong, it's here. China, it's here. How do you bridge the gap? And I think that's where a lot of the problems, including share price volatility, comes from. And now, how do you integrate two markets with different standards? About 10 years ago, I wrote a series of articles. I actually turned it into a book. It was quite controversial at that time. I was on the listing committee at that time, and I let my views be known. My thesis at that time was, in my lifetime, Shanghai cannot replace Hong Kong as an international financial center. And of course, the condition is we uphold our core values. And I think in the last 10 years, we have done that. So my thesis, I think, is intact. And I think, I'm older now, but so I hope my thesis will still continue to hold true. It sounds counterintuitive. So you have you integrate two markets with different corporate governance standards. My solution, my recipe at that time and remains today, it sounds counterintuitive. We do not lower the bar. We actually raise the bar. It sounds counterintuitive. Hey, we are here, they are here, so we should lower ourselves to their level. No. I think that's wrong. Sorry, I have a few more minutes.
No, please carry on.
Okay. Let me tell you a story. I asked you a question, Carlson. How many boxes of mooncake you received the past year?
Oh,
many.
No, not many.
Not many?
I sent them back.
I tell you this story. And this is what the regulators, I think the regulators should learn from it. I forgot this 3 or 4 years ago. Now, first of all, in mooncake, and a lot of you got from your friends or your business associates. Most people will bring a couple of boxes home and give them to the co-workers. In Hong Kong, in a mooncake business, you have Peninsula Hotel mooncake, and you have the rest. No, I'm serious. It's true. I think 3 or 4 years ago, I think 3 or 4 years ago, there were problems with inside Peninsula Hotel. People were fighting to get these mooncakes, and the police were called in, and it was a mess. And the next year, Peninsula Hotel said, "Okay, we'll do something about it." The first thing they did was they canceled the buying of physical mooncakes. So now you have to buy online. The second thing they did was they doubled the price. So if you get Carlson, don't send it back. If you get a box of Peninsula Hotel mooncake, don't send it back. The friend who sent you is a good friend, and also be careful. He or she will be asking for something, So now I think the moral of the story is to enhance, to protect, the brand. Increasing the price. Actually, it's the way to go, because and I think Hong Kong as a regulator needs to learn from this. Okay, people come here, Chinese companies come here, or foreign companies come to Hong Kong not because it's easy, it's because it's difficult. There is a premium associated with a Hong Kong listing or Hong Kong presence because of our more stringent requirements. And if we lower ourselves to the standard of Shanghai, then why should Shanghai companies come to Hong Kong? So I think that's my point, and I haven't changed my point. In terms of share price volatility, 100 years ago, John Pierpont Morgan was asked the question. His answer became legendary. His answer was, the market will fluctuate. So I don't know what to do about it. It's something that I think we have to live with. The regulators need to deal with it. And I think the way to deal with it is we have to protect our brand, actually find ways to enhance it. And the way to go is to raise the bar, not lowering the bar.
Oh, okay. Tony, thanks for your theory. Very interesting. I think maybe instead of opening up to the rest of the panel, I think this is a good point for us now to put the question to Stephen, being the chairman of the listing committee. Stephen, no pressure, but according to reports, there have been a lot of activity in backdoor listing, acquisition of questionable assets of businesses, shell companies, all the issues that we read about, and listening to what Tony just said, as a chairman of the listing committee, are you going to go back tomorrow and double the thickness of the listing rules?
Well, thank you, Carlson. I mean, this whole area does concern us and concerns me. And it's an area that we obviously continue to monitor, making sure our provisions are robust enough, particularly with the reverse takeovers, backdoor listings, ensuring that we're not effectively circumventing our initial listing rules. And I think as we look through the last few years, and we all obviously review on an ongoing basis, there's been a significant increase in this type of activity. And it actually appears to result from demand rather than the actual availability of these listed shells, which we've seen in the past as having minimal operations. And I think the reason for this increase has been driven primarily from the mainland, where companies are looking to tap capital markets, and there really isn't much of an outlet for them. The IPO process in China is very lengthy. We've also seen the mainland government basically restricting fundraising in the recent years. So as a result, this demand has led to substantial premiums for our, what we call shells. And we see in the media numbers like 600 million for a main board listing, or 300 million for a gem listing. So what that's resulted in is really now the small cap issuers, they're being looked at as potential targets. And their stock prices, I believe, are coming very volatile. We're seeing them becoming, targets almost as speculation in the market that they may be taken over. I think in response to that, we've tried to look through, where we can tighten the rules. And one of the areas was the RTO rules. And we did tighten the RTO rules, the reverse takeover rules. They are an anti-avoidance. They're designed to catch the backdoor listings. But they're aimed basically at where a company has injects a material asset into a company. And we've been trying, by our guidance, to apply really that there's a full IPO process goes through. And we did issue a guidance letter back in 2014. And as a result of tightening that rule, we noticed a significant impact in the market. The number of cases went from 11 down to 1. But obviously, as you close one door, another one opens. And what we did observe is a shift from companies that were using backdoors by listing assets. They started to look towards cash injections. And these cash injections fell outside of our anti-avoidance RTO rules. And this increase in transactions was very significant. I think in 2013, there were 5, 2014, 13. And then in the first 7 months of 2015, we saw 25 of these transactions. And we observed in a number of these cases, the funds being raised were very, very significant. They resulted in a complete change of control. And often the new funds were then used to actually bring in or start a new business. We also saw in designing these structures, the market perceived that there was a line of around 90%. Whereas if you went over that line, you could be a cash company and you could fall under our rules. And when we looked at these, we observed two things. One is that, we do not have a bright line. And therefore, we've looked back at those rules and issued some new guidance. And that's been basically trying to avoid these companies coming to the market, preventing the cash company itself from starting a new business. We're not trying to stop, valid transactions that are going through, but we are looking at those that really do not meet the right criteria for a viable, sustainable company. Also, as part of our review, we have looked at the general offers. General offers have also increased, and we've been very focused in looking at those general offers to see if they actually involve such things as multiple transactions. What we've seen sometimes is companies will not just make one transaction, they'll make a series over a period of time. So we're looking at ways, can we look at that as a series of transactions? We also considered the material asset disposals because, again, we've observed a significant increase in this, and there's a concern that these transactions are actually cleansing shells. They're actually making shells. And so as a result, when we are actually looking and reviewing these, we're looking at whether the disposal of the significant assets is actually resulting in the business that's remaining. Is it a sustainable, viable business? And if not, then we should probably withdraw the listing. So I think in terms of addressing the question, are our rules adequate? I think the market's developing and the listing rules themselves must evolve with them. I think one of the things the market movements have taught us is that that the market itself quickly responds to the rules we put in place. And therefore, in looking at the rules, we need to apply principles rather than specifically rules, because that allows us to act much more nimbly. However, while a real demand is out there in the market, I think we're always going to find, or market participants are always going to find ever more ingenious ways to achieve the goals they have. I think in that respect, we're the moment, and I think in association with the SFC, we're actually looking at, and to use a word that was used before, a holistic review as to how we develop our rules to make sure they're much more integrated and therefore responding to the market developments. I also think the SFC has a place to play in this as well, because the SFC plays a very important role with regard to the power it has to inquire and investigate companies that actually are involved in these activities and these types of transactions, all with unusual trading. And also in its role as to giving waivers for some of the large cap that we see share subscriptions.
Okay, thank you, Stephen, for that update as to what the listing company is doing about it. Perhaps I can just ask Brian. Brian,
Carlson, before that, if I have a question for Stephen, can I ask now or shall I leave it at the end?
Oh, no, please ask now.
Stephen, you mentioned two numbers from 11 to 1. Are these numbers, when they fall within the 2014 guidelines, meaning they're deemed new listing accordingly, the number is substantially reduced? Meaning that, are there numbers where, say, there is a change of control, but instead of using a VSA, they use just below VSA, meaning a very big major transaction to get around the rule? Do we have those numbers?
I don't have those numbers at hand, but I mean, we are monitoring, and I'm going to say we are trying to take a much more principled approach. So trying to move away from actually having, a distinct rule. I come from an accounting background, and I know from accounting, if we say something is 90%, everything is at 89%. If we say something is 50%, everything is at 49%. So I think you've got to look at the principles, and putting bright lines in is often a way of just really setting people up to sort of manufacture or design transactions so that they meet a goal.
I understand that, but my point is, can we just rely on these two numbers and conclude that actually the position is not that serious?
No, I just think there has been a change in the market, that's all. I think by tightening the rules on the RTO, I don't think we've stopped people going through those transactions. They've just seen it's much more difficult to go through it that way. They saw an opportunity with cash companies. We've tightened that up. I think we've got to be very, as I say, nimble and look to see what's the next
Okay.
design of how people will go about this. But while that demand remains, there is obviously going to be a lot of pressure to continue to find ways to promote these companies.
Yeah. Oh, that's an interesting debate. Perhaps you two would like to continue during lunch. Right, okay. I better move on. Pru, I would like to ask your view from an investor's point of view, so since you are expert in corporate behavior and also responsible investment. Do you have concern with governance behavior comments in Hong Kong? I mean, you heard what's been discussed. What do you think?
Yeah. Thanks, Carlson. Well, anyone in the investment community who's aware of what happened with Volkswagen last year is acutely aware of the consequences of when corporate governance is poorly managed. So this is an issue that isn't just in Hong Kong. It's a global issue, and it's a very big issue of concern to us as being global investors when our clients who are investing on their behalf lose significant value. And I'll just touch a little bit on BlackRock to put it in perspective. So we're a large US asset manager with around $4.6 trillion under management. In this region, and in particularly Hong Kong, a significant portion of funds under management, around 2/3, are passive. So these investments are linked to the various indices such as index funds or exchange-traded funds. And with passive investments, selling is not an option. So we are a long-term shareholder for most of our investments in this region. So what do we want to see from around 900 companies that we're invested in the Hong Kong market? Our focus from a corporate governance perspective is really on competent, independent directors. And I really want to emphasise that word competent. In this region, one of the key challenges is the presence of block shareholders, either state or family. And the corporate governance structure commonly seen in more development markets such as the UK and the US tends to focus on the majority of the board being independent directors. But for these companies in those regions, they are generally widely held, and the dominance of block shareholders or family-controlled companies are really not a significant issue. So if I just focus on family-controlled companies, these have been growing over the last 2 to 3 generations and have, by and large, been successful. And often the founder has created a unique culture which has contributed to the success of the business, and we often see several family members on the board in both executive and non-executive roles. The corporate governance standard in Hong Kong requires that 1/3 of the board to comprise independent directors. And often when we review the composition of the board, and that's probably the first thing that my team looks at from a corporate governance perspective, is who's on the board providing oversight on behalf of us as shareholders. We often do see some relationships between those so-called independent directors and the founding family, although technically under the principles they would be classified as independent. So there's no doubt that there can be a strong alignment of interests between the family and long-term investors, given the family has a significant amount of its wealth tied up in the listed company. And the family too is a long-term investor because selling and getting out of that investment in the short term is really not an option. But we often find with such companies there's a lack of transparency around the operations of the board and in particular the selection process for independent directors. And when I refer to independent directors on the board of a family-controlled company, I'm not referring to just bringing in an outsider who may be disruptive to the operations of the board. First of all, independent directors should be competent and also bring an appropriate set of skills to the board and engage in a constructive way with family members by bringing an independent perspective and constructive advice and counsel. Effective corporate governance of family companies is now more complex and challenging than ever. Companies need boards to help them meet the regulatory requirements, but the most effective boards are those that easily check that box while delivering strong strategic counsel and direction. Recruiting and developing both family and independent directors who go well beyond the basic needs is the secret to building a high-performing, fully actualised board. So I really want to emphasise we are not focused on box ticking, and I have met many competent directors who are actually not independent. So based on my experience in this region, I really classify companies into 3 categories. The first category of family company is the one that completely ignores the rights of minority shareholders, and we see quite aggressive related party transactions, lack of transparency around the board, and generally it's very hard to understand what's going on in those companies. The second group, which is probably the majority of companies, see corporate governance as a compliance issue and a cost. And the focus is very much on just ticking all the boxes, so 3 or a third of the board will be independent. And from an investor perspective, we still don't get an understanding of how the company operates, and it's difficult to get a full understanding of the risks, particularly environmental and social risks, faced by the company and how those risks are managed. And often we engage with these companies and ask for greater disclosure on certain issues, and we're simply told that they can't disclose due to regulation, which we find quite an interesting response. The third category comprises companies that embrace corporate governance as a strategic issue. These companies value constructive input of independent directors can make in the decision-making process of the board. Disclosure is generally comprehensive, particularly in relation to the company's exposure to environmental and social issues. Disclosure is more transparent, and they don't see corporate and social responsibilities as a philanthropic exercise, but as a strategic issue to the company. And these companies really do stand out, and where we have our active managers, these are the companies that really our active managers would be more interested in. So some specific issues, in particular related party transactions, and it is acknowledged that Hong Kong does have a strong regulatory environment when it does come to related party transactions. However, we really do have some specific issues. Firstly, explanatory memoranda, while often 400 pages plus, often fail to explain to shareholders why they should support the proposal and what the long-term benefits are. And in fact, we have a saying that the longer or more pages that the explanatory memorandum has, the less information is disclosed. And the role of the independent director in these particular transactions is quite crucial. The INED, in our view, has a duty to ensure that transactions are in the best interests of minority shareholders. And in our engagements with INEDs on related party transactions, some simply see their role as to opine on the independent financial advisor report and not engage with the major shareholder, to get a better deal for minority shareholders. And we feel rightly or wrongly that there's a lack of rigorous discussion between INEDs and the related party about getting a good deal for minority shareholders. So what type of regulatory change would we like to see? And I will just focus on one issue, and that's really improving the accountability of the INEDs on the boards in Hong Kong. As I said before, when I pick up an annual report when we're trying to assess the corporate governance standard of the company, the first section I go to is the board of directors to find out who's on the board. Often we'll get the name, the age, their qualifications and their current and former directorships. Nothing about the skill set that they bring to the board. And in our engagements, not just with companies but with organisations like the Company Secretaries Association, we're trying to encourage greater transparency about who is actually on the board. And what we'd like to see is companies to disclose the vote of minority shareholders on independent directors separately from the controlling shareholder. And where there is not majority support for those directors, that the company be required to report back to the exchange about why that director should remain on the board if it doesn't have the support of the majority of the minority shareholders. We'd like to see more focused training for independent directors to really understand their role vis-a-vis minority shareholders. And another issue is a restriction on overboarding. I had an engagement with a company 2 weeks ago, and one of the directors sits on 17 boards. And because BlackRock is so large, we're actually shareholders in most of those companies. And it's not possible for that person to undertake the role that we expect as our representative on the board when there are 16 other boards they sit on. So if INEDs themselves understand the importance of their role together with an environment that places more accountability on them, we believe that this may lead to a change in their behaviours and better outcomes for minority shareholders. We're very supportive of the introduction of a stewardship code, but that will have to be matched with an environment where both institutional shareholders and retail shareholders can be active and responsible owners in this environment. So that's my views on where we see corporate behaviour and what might influence changes to improve corporate behaviour.
Right, Pru, thank you very much. And you put forth some good suggestions. I totally agree with you. The accountability of INED is so critical. At the day when they put their earning, $40,000 fee a year and just attend board meeting are long over. Now, I think at that point, we probably nicely lead to my next question. For KS. Now, KS is the chairman and CEO of, I believe, a family-controlled company. Which category does your company belong to? The three categories that and he's not answering me. And also, what's your view on the relationship between corporate governance and long-term sustainability of company? Is it a matter of having right culture? But how about, and Tong at the top, and what Pru suggested, of more disclosure, your general views, as I said, the chairman CEO of a family-controlled company, which there are many on the Hong Kong Stock Exchange. Yes.
Thank you, Carlson. I've never seen a large clock like that ticking away, so I don't have much time.
No.
Very fast.
No, you have all the time you need.
I want to thank Pru for really giving a very incisive analysis of the situation, especially in Asian family-controlled companies. And you have your words right on where the problem areas are and where we can go from there. But I just want to reassure you, though, that things are changing also in Asia. You're describing some of the first-generation owners who are now passing in the second generations, and I think what you have described will be coming into play, and some of the suggestions will actually being carried out in a lot of companies, including my own. So that was very good. I just want to say that. So for my part, I'm supposed to talk about long-term sustainability of companies in the situation of what kind of corporate governance. And since I don't have a lot of time, I just want you to take away this concept that I think is very, very important for a company to have a corporate governance culture that really is mindful of, care about the long-term sustainability of a company. And I'm going to talk about something about long-termism versus short-termism. And if I can say that, this idea of long-term, which I know for a long time being a practicing businessman, but this concept was actually introduced to me by Ashley Elder. He gave me a paper about 2 years ago. Yeah, John Kay wrote a very long report to the FSA, I believe. Of course, different people reading it. I think I encourage you all to read that, John Kay, K-A-Y. Very interesting report on really where is the capital markets going, where is the equity market going, what should we do, should we go back to basics of why a company is listed. Very, very interesting questions, and I think people take different things out of it. I'm going to take my part out and talk to the audience here. So we all know that, I believe this is proven again and again, that the value of an enterprise is much bigger if it has long-term sustainability. And by that, we mean for them to attain long-term shareholders' value, it must maintain long-term growth and profitability. Of course, that's easier said than done, but this means that the board and management must have the capability to make the right decisions and be able to navigate through all the risks as it goes on for a long period. And I think to do this, though, they have to be very mindful of the long-term interest and value creation of the enterprise and its shareholders, but not overly focused on short-term. So Pru has talked about a lot of the family-controlled companies, but in defense of some of the family companies, some studies, especially I think one big one in Switzerland, have shown that majority-controlled family companies which have very long-term vision and mission, they actually do better in value creation. And because they have to hold the shares for generations, so they have to think long term. And they also, one more thing is true, I want to ask that in a family, there is normally a supervisory control system that controls the public company board, even though they control that. So it's two-tier, a little bit like the German supervisory board. And that helps in guarding against some wrongdoings in the people who are in the management. That is something that I find very interesting, and I think it's something that we should be looking at sometimes when we invest in a company. Now, on the other hand, I want to quote you some very interesting observation by the conference board this year, and that is the US Fortune 500 CEO average tenure is only 9.7 years. You mentioned that some of the family control are too long, like mine, but and the average lifespan of a US 500 company average is only about 20 years, and this has dropped from, I remember reading it, is 40 years about 20 years ago in 1990s. It was 40, now it's dropped to 20 years. So things are really getting shorter and shorter, even the lifespan of companies. And I can only tell my own story. In my 35 years of business life, I was something else before that, but in my 35 years of business life, I found that the most profitability that I make are in projects that are very, very long term. For example, in the project we have in Hong Kong, Langham Place, it took me 15 years. And we went through 3 business cycles, but and in the middle there were attacks from my shareholders, my directors saying, why are you into this kind of things? But we hung on, and today it would have returned to us about 500% on its original value. So, but really it's having a good idea and really keeping at it long term that I find, and there's several other cases, even in my own little company, that we found that we do the best if we hang on to a good idea for a long term. I mean, I've done short term investments, and all I can say is sometimes you win, sometimes you lose. That's called speculation. So, 2 more minutes. Now, why then, in today's stock market and other investment today, why do we have so much short-term thinking in play? I think a lot of managers of the companies, they adopt short-term strategies, they focus on accounting-driven metrics and profit maximization to satisfy the monthly report, the quarterly reports, and then the earnings per share, the share price. And some of them, not all of them, some of them even stop spending on research and development, maintenance, and even hiring good people because it really increases the expenditure on the short term. By doing that, they increase the profit on the short term and the share price does better in the short term. And some of these are, a lot of managerial incentives we found are often based on short-term quantifiable results. And share options is one of the worst. And it makes managers focus on share price, which is very short-term, and it would boost the share price if the profit in the short term is higher. But in the long term, it's not so good. But we cannot blame the managers only because there are other things at play. The capital market forces of trading, hedge funds, retail investors, they all look for short-term gain. And in today's trading culture and very share price sensitive, so you cannot blame them. So they put pressure also on the managers to be very short-term. And then regulators, sorry if I said anything wrong, but in response to the marketplace, some of the regulators would set short-term rules like quarterly reporting. You know, I'm a big fan against quarterly reporting. And for overly large volume of data provisions, and I think, sometimes the recently introduced responsible ownership in the FSA in London, sometimes it can be abused into shareholders' activism. And all this emphasis on short-termism are, I think, really a killer for long-term value creation. So what can we do to try to have long-term thinking in the company? I think, as we said earlier, reframe the mindset, okay? Develop corporate culture of long-term thinking set KPIs for those, and this is not very easy. Motivation, quality, leadership, innovation, succession planning, but I don't know how do you quantify these for performance management. But it's something that I would bring up. And then maybe the regulations should aim to reduce the pressure on short-term thinking, decision-making, and reduce overly frequent reporting and investment performance reporting. As Pru said, establish a board of independent directors who are tasked with the job of thinking long-term, strategy for long-term vision and mission of the company. And I want to introduce this concept from John Kay's report, is stewardship. What are we to the stakeholders? When we buy a share, when we invest in a share, can we become the steward of the company? We take care, you take care of the company, you watch it grow, nurture its growth from childhood to adulthood. You care about the company, you own it, and you want it to do well. And this stewardship concept is really, I think, we have to get back to basics of why a company is listed and why we invest in it. I'm raising all these because I think we have to recognize that this tension between the long-term intention, of course, everybody wants to do well, but the tension between that and the short-term action is one of the greatest challenges in today's modern management. And I really plead that attention should be focused on this stewardship concept and long-term sustainability of the companies. But Carlson, I can have 2 minutes to respond to something that was said before. I see all the slides about all the bad things going on in the Hong Kong stock market. And I was chairman of the listing committee actually for 6 years on the main board, and then 4 years on GEM board. So I was the longest serving listing committee chairman in Hong Kong. I've seen a lot of companies come and go, okay? And they're bad ones, but they are good ones. And as Charles Lee said, China has different set of circumstances and criteria. They do things slightly differently. I think we have to take all this. But my advice has always been, do not close the door to 999 good people just because we are worried about one thief. Okay, we have to we have to establish very strong policing and monitoring system to catch that one thief, punish them, and show that we are serious in catching the thief. But let the good guys come in. We need them in Hong Kong. And thank you very much.
Clearly, I think what KS has struck a chord with some of our audiences here. Thank you. Now, I wouldn't be doing my job if I don't ask one question, which is, what about our GEM market? I mean, you were the founder. It's all your fault. You were the founder of the GEM market.
I was told to be the founder. No, really, GEM has its purpose. When we established it, it was for growth company and for companies that are supposedly in the new economy. But of course, you cannot stop other companies from coming in because you can only set certain rules and criteria for entry. But later on, it was put as you can graduate to the main board. My original idea was that it'd be like a NASDAQ board. But when you say you can graduate to the main board, everybody jump onto the main board, especially now main boards are worth 500 million and GEM board is only 200. So once you do that, then GEM would never have a life. It will always, what they say, I'm sorry, it's like a mistress board. It will never be and I think that's the problem. But maybe it's time to relook it, revitalize it. There is a place for it. In China, they have even an angel board. As I was talking to you, I invest a lot as angel investors. I would love dearly to have an angel board where at least the statements are audited and proven. I mean, right now, I've lost lots of money as an angel investor. I couldn't even see a single figure. I didn't even know what I lost the money in.
You should be investing in it.
I know, now I know. But if you have an angel board, then maybe things would be even better.
Now, let me perhaps I put it to the floor, Tony and then Stephen. What do you think about the GEM? Maybe Tony first. You were a member of the listing committee. What do you think? I mean, is the GEM operating what it's meant to do, or you think there needs to be reform, or should we get rid of it? What do you think?
Well, there is a perception thing about, being the small brother. But, I think GEM has a purpose because of the lower qualifying requirements. So the GEM does allow smaller companies to become public. And now whether there are many larger GEM companies which refuse to go to the main board, just like NASDAQ. So I think GEM has a purpose, and I think there is a perception issue that what's troubling. That's something I learned from Brian's slides. Over 80% of the GEM listings in the last couple of years were traditional, not high-tech companies. Okay, maybe that reflects the state of Hong Kong economy. I don't know, but so I think there's a purpose. But maybe GEM has a perception issue that I think we need to do something about it.
Yeah, Stephen, what's your thinking?
I mean, I think I'll go back to what was said earlier, which is, I think it was set up for a purpose. I'm not really sure it's fulfilling that purpose. It's like a mini main board. And I do think we have to revisit the whole area just to see, if we are trying to get the sort of new economy companies, I'm not sure we've really got the right vehicle at the moment with the GEM. But I think we need to look at it holistically and make sure that we actually have a very good idea of what the GEM is supposed to be doing before we start changing the rules. And I do feel that it was not really the intention at the start that it would just be a stepping stone to the main board. And I think that's probably the area we have to revisit first to see how we distinguish the two boards. Because at the moment, it does just look like a small version of the main board.
Right. Pru, would BlackRock invest in GEM companies?
Well, the 900 companies that I referred to that we're invested in are main board listed companies.
No,
so, look, I'm not sure, but from our main funds, it would be from the main board.
Right.
Yes.
Right. Brian, what do you think?
I think there is one very important change in circumstances. My recollection was during the time of establishment of GEM board. At that time, cross-border listing or mainland enterprise listing was not as popular as present, meaning that the purpose was to help high-growth technology companies in Hong Kong. That brings benefit for Hong Kong's economy, GDP, and employment. However, things change very quickly. Now, what's the purpose of helping overseas, say, tech company or mainland tech companies for the purpose of raising funds in Hong Kong or listing Hong Kong? I think there's a very important question for us to reconsider the position of GEM.
Right. No, sorry, if I can correct that. Yes. When we started GEM, it was not just for Hong Kong. I mean, I was chasing after Sina, Sohu, and all this, but unfortunately, they were registered in Delaware, and someone in regulator told me, we cannot list Delaware registered company. So they went to New York.
Sorry, KS, I understand that, but the reality was at that time, there were not many private enterprises in mainland listed in Hong Kong. That wasn't the trend. So the thinking was we should focus at that sort of mindset rather than the current sort of very popular mainland enterprises listing in Hong Kong.
Right. I think we have some interesting discussions, interesting points. As we're running out of time, I would like to, the polling questions have already been put forward. I saw answers. The first question, can we have a look, please? The answer to the first polling question. Do you think the current rules and regulations to prevent backdoor listings are effective? There you are. No. 72% of the audience think that they are not adequate and sufficient. So I'll put it back to you, Stephen, and for the listing committee to perhaps put your thinking cap on and see what can be done about it. Right? The next question is, in fact, we had a bit of a discussion about that just now. Do you believe that our GEM market is serving its purpose or should it be reformed? 83% believe GEM reform is needed. Now, I think that's more or less what both KS and Stephen think. So we'll be looking forward to your proposal on the GEM reform. And right, last but not least, should the creation and trading of shell companies in Hong Kong be allowed? 61% no, 39% yes. Now, on that note, perhaps that's a good way. What's wrong with having shell companies? You know, being a devil's advocate, why don't we want shell companies? Brian?
I would focus more on the issues about, say, due diligence by sponsor. Is that compatible with our current thinking about the sponsor regime? Especially when there is a change of control. And rather than merely talking about the phenomenon of whether there's a shell price and things like that. And if that gatekeeping is done properly, I think that is the direction about the regulation and behavior of the market.
Okay.
Can I just say that if I have invested in a company that became a shell company, I would be very happy if somebody comes to salvage it. But I do agree with Brian that maybe the sponsors should really look into what kind of new things are coming in. And we talked yesterday, Stephen, that maybe it should be looked upon as a new listing when the new assets are to be injected. Okay. So I don't think we should cut it off completely because that really then a lot of small investors would be really damaged.
Right. And any to add?
No, I think it's a natural phenomenon that you will get listed shells. I think we have a strange phenomenon at the moment with this sort of high demand. But I think it's really a case of ensuring that we meet the criteria of protecting shareholders when these things happen, that they're transparent and that they are appropriately regulated. So I'd agree with Brian. I think there is a place. It's a national phenomenon, but we just need to be very wary of it becoming a sort of a business.
Yeah, Tony.
No, I agree. Shell companies have been around for a long time, not just in Hong Kong. In Australia, in Canada, resource companies, go out and try to do business and fail, and they become shell companies. Okay, but the problem in Hong Kong in recent years, it's companies set out to be a shell company from day one, and there is a degree of dishonesty involved. Okay, I think that's a problem. If KS, when you bought into a company which for different reasons it become a shell company. Okay, but I don't think you will buy into a company which tell you on day one that I will be a shell company in 3 years' time, and I will return the business to you, and I will get $500 million.
The only thing is, sorry, Chairman, I think when people come for IPO and they fulfill the criteria, okay, what do? It may become a shell company in 2 years, but if they fulfill the criteria and you have certain rules, I think you have to treat everybody fairly and equally.
Yeah, I think that the concern at present is some companies set up to look as if they have a real business, but in fact, at the back of their mind, they actually want to sell as a shell company.
Then it depends on the sponsor's due diligence.
Yeah, this is a big topic. I think in closing, we're running out of time now. Clearly, I think Brian's slides show that there's something not quite right with certain companies on certain section of the market. That I think the figures speak for itself. And obviously, KS suggested that we shouldn't strengthen the whole market just to stop things from happening, and we should deal with those who break the rules. In fact, as Stephen said, Tony said, we need to, in fact, stiffen our rules. So we should have a tougher enforcement to make sure that thieves are caught. But one last message, which is very clear, it seems, from the polling question and from what I'm hearing, the joint market probably need a review, a holistic review. Shell companies really isn't something that quite right, and something should be done about it. But on that note, I think there's a lot on the plate of the regulator, of the listening committee on SFC. But finally, I'd like to ask all to give a round of applause and thank our panelists for taking the time out. Thank you.